A home equity agreement is a little-known way to tap into home equity without the high interest rates and qualifying headaches of a regular home equity loan. Sounds interesting, right? But is it legitimate? We'll cover how it works and some important considerations to keep in mind. Please click the like and subscribe buttons. It helps our channel and notifies you when we post new videos. If you've checked into a home equity loan lately, you probably already know that interest rates aren't what they used to be. These days, a home equity loan can cost $250 to $300 per month to borrow just $25,000. If you borrow $100,000, it could cost $1,000 to $1,200 or more per month. That's an awfully big payment for that size of loan. And if you happen to have bruised credit, limited income, or difficulty proving your income, it can be tough to qualify for a home equity loan. Fortunately, a regular home equity loan from a regular bank is no longer the only game in town. A new option is available that has worked well for many homeowners: the home equity agreement. A home equity agreement enables you to convert home equity into cash without the high interest rates, payments, and qualifying headaches of a regular home equity loan. Home equity agreements can be structured in various ways, but here's how they typically work. You receive a large lump sum of cash based on the equity in your home. Payouts can be anywhere from $30,000 to $500,000. Unlike a regular home equity loan, no monthly payments are required, and no interest is charged on your payout. You remain the owner of your home, which means you'll continue to pay your property taxes, homeowners insurance, and homeowners association dues, if applicable. Because there are no monthly payments, there are no minimum income requirements. You may qualify even if you have no income at all. You also don't need perfect credit. The minimum required credit score is usually around 500. You also don't need to pay off or refinance your existing low-rate mortgage. In exchange for a lump sum payout, you agree to repay the investor a percentage of the value of your home at a future date, such as when you sell your home, the last borrower passes away, or the contract term ends. Home equity agreements are not available in all states and not everybody qualifies. If you would like to check your eligibility and see how much you can get, click the link in the description or comments below. Home equity agreement qualifying guidelines vary from one provider to another, but here are some of the most common requirements. First, you need to own your home and have a significant amount of home equity. Your home doesn't need to be perfect, but it needs to be in at least reasonably good condition. Primary residences, second homes, and rentals are eligible. The minimum credit score is 500 with income verification. If you can't prove your income, the minimum credit score is 550. You must not have any major derogatory credit in the last 3 to 5 years, such as foreclosures, bankruptcies, and short sales. You must also have at least a reasonably good payment history on all mortgages that you carry. Keep in mind that these are just the most general requirements. Guidelines can change at any time and vary from one provider to the next. The advantage of a home equity agreement is that it enables you to convert home equity into cash without adding another payment to your monthly budget. Homeowners commonly use the funds to reduce monthly expenses by consolidating credit card debt, auto loans, personal loans, and other debt. You can use the cash to improve your credit scores by paying off high-utilization credit card debt that can damage your scores even if you make your payments on time. Many homeowners use a home equity agreement to clear up medical, dental, and vet bills, do home repairs and improvements, set up a rainy day fund to cover future emergency expenses, or pay for college tuition and expenses. Many homeowners also use the funds to invest in a business. Small business loans can be difficult and tedious to get. A home equity agreement can be a great funding source to start a new business or grow an existing one. You're free to use the money for whatever you need. A home equity agreement comes with a lot of advantages, but there are some important considerations to keep in mind. Remember, the home equity agreement provider wants to get repaid at the end of the contract term. If you don't sell your home, you'll need to pay off the home equity agreement with cash or another loan. The contract term usually lasts 10 years or more, so at least you have a large time window to work with. Like a regular home loan, home equity agreements usually come with at least some closing costs, including origination, title, escrow, and other costs. Of course, regular home equity loans typically have closing costs as well. You may have to pay additional title, reconveyance, escrow, appraisal, and administration fees when the home equity agreement provider processes the final buyout at the end of the contract term. It's important to continue maintaining your home. If you allow your home to deteriorate, the home equity agreement provider may assess a maintenance adjustment on your home's value at the end of the contract term. In other words, they may increase the final value to what the home should be worth had it been maintained, then figure their buyout based on that number. Home equity agreements are relatively new, and few mortgage lenders understand how they work. You may find it difficult or impossible to get a regular mortgage without first paying off your home equity agreement. Home equity agreements are a potentially beneficial way to tap into home equity to consolidate debt, pay medical bills, do home improvements, or make a large purchase. But it's important to look at the whole picture and make sure it's a good fit for your individual circumstances. Make sure you understand the terms and potential downsides thoroughly before you sign the final agreement. You may want to enlist a trusted advisor to review the terms as well. A home equity agreement enables you to convert home equity into cash without the high interest rates, payments, and qualifying headaches of a regular home equity loan. Use the cash to wipe out debt, rebuild your credit scores, invest in a business, pay college expenses, or anything else you can think of. If you would like to check your eligibility and get a free payout estimate, you may want to start with Unlock, a leading provider rated A+ on Trustpilot. Simply click the link in the description or comments below.